Greg Winchester, Managing Director and co-owner of Trimont Real Estate Advisors, located in Atlanta, Georgia. We provide asset management and servicing on about a $55 billion portfolio for various clients. On a selective basis, now is a good time to invest in real estate because prices are down, interest rates are low, and real estate is a potential protection against inflation in the future. There are value-add opportunities. They're hard to find, but if you can spend the time and work your way into the properties on a property-specific basis, you can find some outstanding returns. And secondly, there may be some opportunities for development beginning next year where properties will be developed and stabilized and completed in the next 2 to 3 years after we come out of this economic cycle. We deal with all property types, but particularly multifamily, office, and the hospitality sector. You see a wide variety of changes within each sector. We see that in the multifamily sector, the B+ to A properties are continuing to improve in fundamentals and expect them to continue to do such. The B quality apartments and lower are suffering substantially due to the employment picture in the United States. The office market is probably the most troubling for us at this time because of the job outlook picture and unemployment and shadow space that's occurring within the markets. However, there are certain markets which do offer some unique opportunities because the lack of supply. And then finally, in the hospitality market, we see rebound starting to occur finally after a deep dive in the last 2 years, and some of the better placed, better positioned brand name properties are starting to show solid improvements. Well, capital and credit availability has increased. CMBS has gone from being on the bench to off the bench. You probably will see $15 to $20 billion of CMBS issued this year, and a continued resurgence of CMBS at a slow pace, at nothing like the pace in prior years in the middle part of the decade. The banks are starting to lend again on a very select basis. So you're starting to see very fundamental, old-fashioned underwriting come back and lending come back. The biggest thing that we see this a change from 9 months ago is there is capital available both in the senior debt, mezz side, and equity side, which is allowing refinancings to occur. Real estate has been a global proposition for our company. It tends to kind of come and go dependent upon our clients and their investment horizons and diversification views. We do see that our business will probably increase a little bit, particularly over in Europe in the coming year. It's hard to understand what fully engaged means, but my crystal ball says 2015 because I think you need to have not only the banking system restored and the housing market fully stabilized, you also need to have the glut of houses removed from the market, and then most importantly you have to have consumer confidence back and the consumer purchasing again in a material way.